How to invest in stocks. Stock investing is simpler than most people believe. All you need is an online brokerage account to get started. In 6 simple steps, here's how to invest in stocks. Number 1, make a decision on how you'd like to invest in the stock market. Stock investing can be approached in a variety of ways. Choose the choice that best describes how you want to invest and how hands-on you want to be when selecting stocks to invest in. A, I'd like to choose my own stocks and mutual funds. Keep watching. This video breaks down valuable details for your hands-on buyers, such as how to pick the best account for your needs and how to compare stock portfolios. B, I'd like a professional to oversee the operation. You may be a successful candidate for a robo-advisor, a low-cost investment management service. Almost every major brokerage firm provides these services, which invest your money for you based on your unique objectives. C, I'd like to begin contributing to my employer's 401k plan. This is one of the most common ways for new investors to get started. It teaches new investors some of the most tried and tested investing approaches, such as making small daily investments, concentrating on the long term, and taking a hands-off approach. You're ready to look for an account once you've decided on a choice. Number 2, open a savings account. In general, an investment account is required to invest in stocks. This typically involves a brokerage account for the hands-on forms. Opening an account with a robo-advisor is a good choice for those who need a little support. Both processes are described in detail below. A key point to note is that both brokers and robo-advisors allow you to open an account with very little capital. Buying stocks, funds, and a number of other assets is likely to be easier and less costly with an online brokerage account. You may open an individual retirement account, also known as an IRA, or a taxable brokerage account with a broker if you're not saving enough for retirement in a 401k or other plan at work. Opening a robo-advisor account as a passive choice. A robo-advisor provides the advantages of stock investing without requiring the owner to do the legwork involved in choosing individual investments. Robo-advisory services cover all aspects of investment management, including during the onboarding process. These firms will inquire about your investment objectives and then build a portfolio to meet those objectives. Although the management fees can seem to be high, they are typically a fraction of what a human investment manager might charge. The majority of robo-advisors take 0.25% of your account balance as a fee. Yeah, you can get an IRA through a robo-advisor if you want to. Number 3, understand the variations between stocks and mutual funds. Investing in stocks does not have to be difficult. For the most part, stock market investing entails choosing between 2 forms of investments. ETFs, exchange-traded funds, are mutual funds that are invested in stocks. In a single investment, mutual funds allow you to buy small parts of several different stocks. Index funds and ETFs are mutual funds that follow an index. For example, a Standard & Poor's 500 fund buys the shares of the companies that make up the index. You own small parts of those businesses when you invest in a fund. To build a diversified portfolio, you can combine multiple funds. It's worth remembering that stock mutual funds are also known as equity mutual funds. Stocks that are kept individually, if you're interested in a particular company, you can buy a single share or a few shares to get your feet wet in the stock market. It is possible to construct a diversified portfolio out of several individual stocks, but it needs a large investment. Stock mutual funds have the advantage of being inherently diversified, which reduces your risk. A portfolio consisting primarily of mutual funds is the clear option for the vast majority of investors, especially those investing their retirement savings. Mutual funds, on the other hand, are unlikely to grow as fast as certain individual stocks. Individual stocks have the advantage of a wise choice paying off handsomely, but the chances of any individual stock making you wealthy are extremely slim. Number 4, build a stock investment budget. In this stage of the process, new investors often have 2 questions. How much money do I need to begin stock investing? The amount of money needed to purchase a single stock is determined by the price of the shares. Shares can be purchased for as little as a few dollars or as much as a few $1,000s. If you want mutual funds but don't have a lot of money, an exchange-traded fund, ETF, may be the way to go. ETFs trade like stocks, so you buy them for a share price, in some cases less than $100. Mutual funds also have $1,000 or more minimums, but ETFs trade like stocks, so you buy them for a share price, in some cases less than $100. I'm not sure how much money I can put into stocks. If you're investing through funds, have we mentioned that most financial advisors prefer this method? If you have a long time horizon, you can allocate a substantial portion of your portfolio to equity funds. A 30-year-old investing for retirement could invest in stock funds for 80% of his or her portfolio and bond funds for the remaining 20%. Individual stocks, on the other hand, are a different matter. As a general rule, limit these to a limited portion of your overall investment portfolio. Number 5, keep an eye on the big picture. Stock investing is rife with complex strategies and methods, but some of the most active investors have stuck to stock market fundamentals. The smartest thing you can do after you start investing in stocks or mutual funds is to ignore them. It's best to stop the practice of checking how your stocks are doing many times a day, every day, unless you're trying to beat the odds and excel at day trading. Number 6, keep track of your stock portfolio. Although obsessing over daily fluctuations isn't good for your portfolios or your own well-being, you'll need to check in on your stocks or other investments from time to time. If you use the measures above to buy mutual funds and individual stocks over time, you can check your portfolio at least once a year to ensure it still meets your investment objectives. Here are a few things to think about. If you're nearing retirement, you may want to shift some of your equity investments to safer fixed income investments. Consider purchasing stocks or funds in a different sector to diversify the portfolio if it is too heavily weighted in one sector or industry. Finally, regional diversification should be considered. International stocks can account for up to 40% of your portfolio, according to Vanguard. To get this exposure, you can buy foreign stock mutual funds. If you want to know more financial tips like these, make sure to give this video a like and click subscribe. Thanks for watching, and see you in the next video.